So, looks like the Federal Reserve is going to be lowering interest rates this week. And, you might think that this is just a normal rate cut for economic reasons, which is understandable, especially given some of the data that's come out recently. But what if I told you that this is starting to look more and more like there's something underneath the surface, especially with the political attacks against the Federal Reserve, specifically Jerome Powell and other members of the Federal Reserve? And what if I told you that this is actually starting to look like a playbook that hasn't really been used since the 1940s? And so I want to go and explore that further with you today. But before we do, as always, my name is Zachariah Montera. I'm one of the private wealth managers here at Fross and Fross Wealth Management. And before I get too involved into this, I want to just give you a short overview of some of the key takeaways from this and what I'll be covering. Number one, Federal Reserve independence. It's not something that is unprecedented if you look at history in terms of the Federal Reserve not being independent. It actually hasn't been an independent agency for some of its history, especially when it first started. And it became independent through legislative action in 1951. But prior to that, it was not an independent agency. So that's number one, just to kind of put that in context. Number two, some of the implications of this has to do with doing some things with potentially some of your short-term funds that you might need access to in the next 12 to 18 months. If you're a client of ours, then you already know how we structure our portfolios for short-term needs being much more conservative than long-term needs. Those should be invested more aggressively because we need to outpace inflation. But if it's money that you need within the next 12 to 18 months, you're more concerned and we're more concerned on you receiving a return of that money where you get it back, opposed to the return on that money. Of course, it's nice to earn something on it while it's sitting there for your short-term needs, but ultimately we need to make sure that it's there for you when you need it. And so there will be some implications for that. And then third, the final implication is somewhat optimistic in terms of geopolitics, and I'll make that part brief. So to go into this with the Federal Reserve lowering interest rates right now, it appears that with the political attacks on the Federal Reserve, I firmly believe that this would be a bipartisan issue, meaning regardless of if Trump was in office or anyone else, what is going on with the Federal Reserve right now, where they're potentially losing independence as an institution and becoming more politicized, would be bipartisan, solely for the reason of our current debt situation. We are at the point in our debt cycle where the Treasury Department and the Federal Reserve probably need to be an organized institution cohesively working together. What does that mean realistically? Well, if we look back at 1940s with World War II, we had a big funding issue to create funds to support the war effort, whether it was us providing vehicles and things like that and arms to Britain through the Lend-Lease program that we had, or providing funds for domestic armament here and building up our armed forces and providing money for our workforce and everything like that. It was very popular to see ads everywhere at that time for war bonds, and it was a patriotic thing to buy the government debt. It was viewed as patriotic. You're supporting the war effort. Even if you're here at home, you can do that through buying war bonds. And part of that, with the Federal Reserve and Treasury being joined together, is that they were able to cap interest rates. Right now we have a market-based interest rate where it's buyers and sellers, just like your home. The value of the government bonds that they issue to cover their deficit is primarily driven by market dynamics between buyers and sellers, between people wanting to buy something at an attractive yield or saying, hey, you know what, 4% on a government bond that I need to hold for 10 years, I think I want to earn more than 4%, or maybe they say they're comfortable with that. And so that's how it's been determined for quite a while. But there was a period in the 1940s up until about 1951 where the Treasury Department and the Federal Reserve capped interest rates at 2.5% on the 10-year, and at it was, I think, 6/8% or 7/8% on the short-term rate. And the reason they did that is they were just capping rates so that they could not have the problem like we have today, which is the interest on the government debt alone accounts for 14% of the budget. And so that's why you've seen the attacks and Trump's administration going after Powell to lower rates. It has nothing to do with the economy. And by all means, anyone in his position, realizing the situation that we're in with the debt, would be doing the same thing. Because think about this with your personal financial situation. If you're going to buy a home and you think that a 30-year mortgage rate is too high, maybe you do something at a maybe a little bit lower rate or comparable, but let's say you do it on a 5-year balloon mortgage where you'll have to refinance it in 5 years. That's a choice you can make if you think rates will be going lower, or you just want to move that to be a more short-term obligation of yours. And that's essentially what the government is doing. And if they're able to lower the short-term rates with the Federal Reserve, Scott Bessent at the Treasury will issue more government debt that we need for our deficit and just for refinancing. He'll issue more debt in shorter term maturities at lower interest rates. That is how they're going to bring down the deficit on the interest side. They already tried Doge this year. That didn't work. They're not going to cut entitlements. They're not going to raise taxes. And even then, raising taxes wouldn't account for too much realistically, because during World War II, we also raised taxes. And if you look at the amount of tax revenue that the government's receiving as a percent of the economy, in World War II, it peaked at 20%, meaning the government was collecting 20% in taxes, 20% of the economy in tax revenue. And ever since the end of World War II, it's pretty much hovered between 15 and 20%. And we're pretty much right there in the middle of that today. So raising tax revenue, yes, might incrementally add a little bit extra in revenue, but the easiest way for them to attack this is going after the interest rate. So what does this mean for your portfolios? What does this mean for markets? Number one, as the markets digest this over the next 12 to 18 months, it's something that they're kind of grappling with. I would say if you're looking at the stages of grief, they're still somewhat in the denial to maybe anger phase. Haven't gotten to acceptance yet. And so there's some possibility of some volatility in the markets with this. But long term, this will be very beneficial for assets such as real estate, stocks, and most likely gold as well, which is why we bought gold in our portfolios earlier this year. And it's going to likely be a longer term holding. As people around the world look at gold as a hedge against that inflation instead of treasury bonds, as there's a very high probability that we're going to be doing something very similar in the coming years where we cap interest rates at a certain level and run inflation higher and not raise interest rates when inflation's higher. So that's a very real possibility, and that has implications for your short-term money as well. If you've been on the fence about some CDs, or you're looking at CDs or treasuries today, maybe they're paying 3.8, 3.9, somewhere around there for a year potentially, and you've been getting accustomed to that 5%, I would say, maybe lock some of that in, reach out to us and, we can maybe lock some of that in if we haven't already, or we're already using other instruments to lock in that yield through other investments. But definitely consider that. It is a lower yield than you've been used to, but there is a very high probability that if we get sustained levels of inflation in the coming years, which is likely, that the government will not raise interest rates to combat that. The reason is, just think of your home since COVID. If you had a mortgage on your home, let's say your home was worth $1 million in 2019, and your mortgage was $700,000. Well, between 2020 and 2023, let's say that your home went from $1 million to $1.3 million, and let's say you've paid down $50,000 on the mortgage. So your mortgage has gone down to $650,000, your home value went up. That's essentially the same thing the government would be trying to do with the debt. If they can inflate the asset side, meaning the home value in that example, if they can inflate the asset side of the economy by making the economy look better than it is by printing money and stimulating the economy just like COVID, if they can raise that asset level, it makes the debt look like it's worth less on a percentage basis. If you're looking at a debt to asset ratio, and that's what a lot of people would look at, it's called debt to GDP. And so they can do that, and that's exactly what we did after World War II. It's not that we paid down the debt, it's really that we inflated a lot of the debt away while paying some of it off as well. So those are the two main implications of this. The third, I'll make this brief, with some of the events over the last couple weeks in geopolitics with India, China, and North Korea and Russia all getting together and discussing their new payment system, their new economic ties and military ties together, it does appear that for the time being, we should have relative levels of peace. And at least on our end, the United States should not be pursuing further military action, just given the fact that 90% of our military supplies come from China. So they have a lot of leverage in this. And so when you think about geopolitics, it does appear that China has somewhat of the upper hand on bargaining on that with the rare earth materials. If you look at anything that has to do with the Chinese tariff relations and all of the economic negotiations, you see rare earths mentioned in almost every single article. And we just extended the 90-day period for China again for the third time. And so with that, there is what's called the peace dividend that is generally good for assets like stocks and things like that. So on a long-term basis, there are a lot of reasons to be optimistic, especially if you're invested with your long-term money, how you should be, to combat against inflation. But just get with us, talk to us about your short-term money. If we've been meeting like on our normal schedule with you and you're already a client, then good news is we've probably already been doing this for you and we already have your short-term money allocated how it should be. I have no doubt about that. But if you have any questions about your portfolio, your investments, or your personal financial situation, feel free to reach out to us here at Fross and Fross Wealth Management. We'll be happy to take a look at anything for you if you're not a client or if you are. Until next time, take care.